Welcome back. I'm here with Jonny Matthews. On today's show, we're going to discuss the recent developments in the US market, the CPI data and the non-farm payroll report.
Yep. There's plenty on the show. I'm trying not to just put in too many charts. Got lots to talk about when it comes to Fed policy and the implications of this CPI report.
Let's get on with it. Hi, and welcome to Supermacro's second podcast. My name is Elvis, and I'm sitting opposite Jonny Matthews. Hi, Jonny.
Hi, Elf.
Jonny is the heart and soul of Supermacro and the author of the Supermacro Morning Note, which goes out to all major US and European banks plus some hedge funds. Jonny, since we last had a podcast, there's been a CPI reading and non-farm payroll data to analyse. Tell me, what's changed? Have you changed your view on the economy? So you are still the recession denier. Does that still stand, or what are you thinking?
Yeah, absolutely it does. I mean, we had a second hotter than expected CPI print, and for some reason the market initially didn't have much of a reaction to it. Treasuries actually rallied after the CPI print. I was surprised. They've since sold off. The payroll data were very, very mixed, and we can discuss that briefly. I've got a chart a little bit later on. But the main thing, as far as I'm concerned, is I think the easing of financial conditions is really stimulating the economy in a way that the Fed probably didn't expect.
That's the chart we're showing here, is that right?
Yeah. This is the Goldman Sachs Financial Conditions Index. And, you know, I'm no great fan of these designer indices because you don't really know what goes into these things and you don't know how this really relates to the economy. But all these financial conditions indices generally have at least three components: credit spreads, recent returns from equities, and long-term fixed income yields. And what we've seen over the last few months, since the Fed started to get concerned about tighter financial conditions in November, was a dramatic easing of financial conditions as a result of credit spreads that have tightened and equities that have gone through the roof.
So what happens when the Fed decides in June, okay, we've promised we're going to do it, forward guidance is there, we've got to start cutting rates come what may. What happens then?
Well, I think the problem as far as the Fed is concerned is they have kind of pointed the ship towards Fed rate cuts and tied themselves to the mast. And they're not going to change their mind because they believe that forward guidance is an important part of the policy toolkit. And for forward guidance to retain its credibility, you have to follow through with what you said you're going to do. So I do think, because the dot plot showed 3 cuts this year, I think they will actually cut at least twice. Well, I don't think inflation is going to slow much from here. I really don't. But I do think they'll go ahead with the cut in June. I've got some charts to explain that. But first, before we move away from this financial conditions, you might say, well, what does it really mean? But it is easing financial conditions like this do have an impact on the economy. If you take the household sector, the increase in wealth has been dramatic. We just had the fourth quarter financial accounts of the US produced by the Fed that showed a 4.8 trillion increase in household wealth. So that was around about 3%. I think net household wealth is about 150 something trillion. So it's a huge increase in household wealth.
It's like about two-thirds of the Fed's balance sheet that just increased. Let me ask you a question. Household wealth. Is that what's driving the economy at the moment, do you think? You think that ultimately people are happy to spend knowing that they don't need a backstop of lots of savings?
Well, I think what you're seeing here with these easier financial conditions is a reflection of this surge in household wealth. Household wealth in the fourth quarter rose by $4.8 trillion in the US. That is a huge amount. It's very difficult to put trillions of dollars into context, but let's put it this way. That's about a 3% increase in total household net worth in 1 quarter. The point about that is, as far as consumers are concerned, the job market is still healthy. We're still printing steady job gains each month of over 200,000. Wages are growing faster than inflation, have been for the last year or so. Or certainly disposable income is growing faster than inflation. And this increase in wealth means that households have less need to boost their discretionary savings.
I'm going to challenge you on one thing you said there. I think that we could, I don't know whether we both agree on this, but the jobs market has eased a little bit, as i.e., I don't think firms are shedding employees, but they're less keen to take them on. And that's showing up not only in the quits rate, and that's showing probably in the average hourly earnings, which is probably mildly lower. I wouldn't say it's going a lot lower. It's definitely coming lower.
Average hourly earnings, I think, in this most recent payroll report grew by 4.3% year over year. And it's the same rate as they have done for the last 4 or 5 months, give or take a 0.1%. So average hourly earnings are not really slowing down. Now, we'll get the Atlanta Fed wage growth tracker on Friday, I believe.
Right.
So we'll get a better idea, the true, a more granular idea of where the pace of earnings growth. But I do agree with you that the payroll report was a bit ambiguous. There, it wasn't clear cut. Unemployment rose from 3.7% to 3.9%. But that unemployment rate comes from a separate survey, comes from the household survey. They survey 60,000 households and ask people, have you got a job or not? It's
right.
It's as simple as that. The establishment survey, where we get the payroll numbers from, it's a survey of, I think, 130-something thousand organizations with 600,000 workplaces. And if you think of a workplace, like an office block, how many people can work in a single workplace? It's thousands. So the establishment survey...
It's a much deeper survey.
Yeah, and it's accurate to plus or minus 100,000. And the household survey, where we get the unemployment rate from, is accurate to plus or minus 600,000.
Right.
So you really want to focus on...
You need to get that in context of when you're talking about both either the establishment or the private pay or the private creation of jobs.
So we saw some weakness if you just looked at the unemployment rate going from 3.7% to 3.9%. But I'm going to skip forward to this chart.
Yes.
Yeah, my favorite chart of cyclical and non-cyclical
We discussed
job
this
gains.
last time, didn't we? I think you've now added a further bar, which is February. So take us through that, Jonny.
Yeah, it's the same thing. The red components here that you're seeing on the screen, these are the non-cyclical job gains, which is government, education, and healthcare, which print typically 100 or so thousand each month, and it doesn't really change. They really are non-cyclical, or certainly they have been over the last year.
Well, they've been very consistent, haven't they, for the last year?
I mean, of course, if the economy does fall into the abyss, the government will cut back on jobs. State and local government will cut back, certainly, but they don't really vary from month to month. The blue bars are everything else. So that's just every other industry: manufacturing, finance, mining, leisure and hospitality, all that stuff.
Are they seasonally adjusted?
Yeah, this is seasonally adjusted, absolutely seasonally adjusted. And people often criticize the BLS. They say, they haven't got the seasonal factors right. They go back and benchmark these factors every so often. In fact, I think they adjust the seasonal factors. I think they update them every month with each new bit of information. But there's no reason to doubt the accuracy of these numbers to within the bands that the Labour Department say, which is 100, 125,000 or so. Plus
the
or
last
minus.
3 months, December, Jan, and Feb, look very solid in the cyclical creation of jobs.
Yeah.
Do you see this sustainable going forward? Bearing in mind we've got very low unemployment, and have they still got the ability to create that many jobs?
Well, I think if you if you look at the 3-month average of job creation, I mean, you don't need to put it on the chart. You can just look at these last 3 bars and see the average over the 3 months is much higher than the prior 3-month average. And in fact, the 6-month average job creation also ticked up. I can't remember the numbers offhand, but it's also picked up. So you'd be hard pressed to make an argument that job growth is slowing down. There are indicators like the NFIB survey.
Just about to ask you about that.
Yeah, the quits rate in the JOLT survey that suggests the labour market is softening a little bit.
Do you think the NFIB survey, which looked very weak the last time I looked at all the data, is a bit emotive, and it's also affected by who seems to be coming in president, which is
yeah. When you look at the headline in the NFIB survey, definitely, I would say the majority of the people that respond to the survey, the small business owners, are Republican voters, and the NFIB survey surged when Trump got elected, and it's been on a kind of downward trend ever since.
Biden. Yeah, absolutely. Okay, so it's not a super reliable.
But the Labour questions in the survey.
You feel as though they're more accurate?
Sometimes they're a good indicator. They're not consistently good. Let's put it that way. That's the problem. They're not consistently good. You can line up job growth. The actual from the establishment survey with indications from the NFIB survey, as a leading indicator, and it works for a short period and then it goes astray.
Right.
But it's like all these things, like I said, I call them designer indices. You can create a designer index which will tell you where the economy is going or the labour market is going. Until
it doesn't.
And then it stops working. And you know as well as I know, we tried looking at
the component of the ISM services employment component, and that was great for 3 months, and then went the opposite way to the establishment survey.
And that was expensive.
Yeah, it was very expensive. I remember that. I remember that trade.
But I do want to come back to what I was talking about at the start of this, the Goldman Sachs financial conditions index, and all these financial conditions indices that shows a dramatic easing of financial conditions in the last 3 months. I spoke previously about the household sector and what great shape the household sector is in, but the same thing applies for the corporate sector, because that easing of financial conditions reflects credit spreads that are close to the tightest in 4 years. So although Treasury yields are higher than they were, the all-in cost for companies to issue debt is not onerous. And in fact, corporate issuance in this current quarter, certainly for investment-grade corporates, is on track to be the strongest ever.
Retail sales, Johnny, they sucked in January. But in your note, I seem to remember you thought the consumption was going to rebound. And are you still thinking the same? Or do you think the figures are going to be a lot better tomorrow?
Absolutely. I mean, I think the show is going to air tomorrow. This is being recorded on Wednesday, so it'll be today's retail sales figures in the States. I do think they're going to show a pretty strong rebound in February for a number of reasons. I think the weather played a part in pulling down January retail sales. Auto sales were very, very weak. I think the auto sector, motor vehicle sales, were responsible for more than half the decline in durable goods sales during the month. And we know from Ward's automotive that unit sales rebounded strongly in February. So that's the number of cars that were sold rebounded strongly in February, right back up to December's pace. Of course, it depends on the value of each car sold, but you can be fairly sure that the total value of auto sales will show a sharp rebound. In the core retail sales, which excludes autos, I also think we'll have a pretty good rebound. I think the weather did play a part. And I think anyway, retail spending and consumption, total consumption spending, ended the year on such a high level, so much higher than the average level during the fourth quarter, that you're almost guaranteed to have a strong quarter of consumption this quarter, assuming the pace of spending stays roughly where it is.
Johnny, it's just something on my mind. You know, I've seen various charts. Each of them seem to have different nominal amounts where it's showing that household savings have been drawn down. Some have been saying been drawn down to zero. Some show there's still a half a trillion. Some show the trillion, blah, blah, blah. Tell me, what are you thinking and what are you seeing?
Well, when I previously looked at this, I looked at it in quite a complex way where I looked at income from we get the personal income and spending report once a month in the US. And I looked at households' disposable income and their spending each month. And you can look at the trend. What's left after that is savings. And you can look at the trend in savings, savings going up, 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 up over time at a particular rate. And then during the pandemic, those savings just went sky high. People didn't have anything to spend their money on. They were stuck at home.
With stimmies.
Yeah. And then they got the stimulus checks
and
all the other government handouts. And for a while, they went crazy buying crap on Amazon. And then they got bored of that. And
I know someone who didn't. I'm not going to mention her on this episode again. Go on.
Yeah. So really, that the level of savings was far above where it was during the trend. But this is kind of a complicated way of doing things. You're looking at the average build up in savings, how it surged above that average trend, and then kind of came down a little bit. Then trying to estimate how much is excess that remains. Now, when I looked at it, it was about $1 trillion by my calculations a little while ago. And I keep reading that, no, the excess savings are almost down to zero. And I find that hard to believe. I want to show this next chart, which comes from this recent fourth quarter Fed report on
this is
the balance sheet of the US.
Yeah.
So this is really, all I'm taking here is cash and cash-like products in bank accounts. It is US checking accounts, time deposits, and money market fund shares. So it's everything that is cash or cash-like. You can if you need the dosh, you can just cash in this stuff and spend it the next day. And so the trend was building up at a fairly consistent pace for 20 years. That's that trend line through there. And then when the pandemic came, all of a sudden there's this surge in savings. Now, you could say it ran down a little bit, but it's since ticked up. But it's still way above the trend line. And it's not like people have cashed in other stuff to build these savings. It's not like they've cashed in their equity portfolio or anything. This is just effectively excess cash that's been building up in bank accounts.
Has the inflation and the increase in Fed funds and all interest rates throughout the developed world done something to accelerate this at all, or is that a small part of it?
Yeah, I would say this is in nominal terms. You're quite right that to some extent. Well,
it looks extremely, from what I can see there, that chart, it looks extraordinarily healthy.
Yeah. I have actually done the same thing. I put it in real terms. In real terms here because what I did was I said, okay, let's take the consumer price index and deflate these so
in real terms,
this is in the equivalent of year $2,000. I've effectively discounted everything back to year $2,000, and what you're seeing here is the same kind of trend where you had this steady growth and then a sudden explosion in savings, which is still above the trend line.
This dovetails with your theory on on household wealth.
Yeah, I mean, when we look at household wealth, most of the wealth in Q4 was produced by increases in equity valuations. It's a combination of additional savings and increases in valuations.
Oh, I see. Okay.
But over the last 10 years, the value of US housing has pretty much doubled. Average house prices have pretty much doubled over the last 10 years.
Jonny, we had the CPI report came out yesterday, hotter than expected. Has this changed your view at all on anything? I know on the Fed reaction function maybe, or tell me what you're thinking.
Well, yeah, I think this CPI print, it did concern me more than more than some people in the market. Um,
Well, what part of it weren't you happy about, or
well, I think
or if you were the Fed, you wouldn't be happy about?
well, I think first of all, it's the persistence of services inflation, which isn't really slowing much at all. We had fairly strong goods price deflation over the last year or so. Energy prices fell, food price inflation is slowing, and that's all great. But that stuff is going to come to an end. We know base effects in energy means that energy prices year over year are going to start, well, certainly going to level out, and at some point may start turning up. Food price deflation is going to, disinflation rather, is going to come to an end soon. Goods prices were falling for a little while, but that's coming to an end now. Goods prices are fairly flat, and I think the trend in durable goods prices is fairly flat, the longer term trend, or very low
So the
inflation.
disinflationary trends within the CPI
Yeah.
are stopping, and that leaves the rest
That
of
leaves-
the rest of the sticky stuff, or the stuff that's either sticky or going higher.
So the Fed has this super core measure of inflation, which basically is services inflation less housing.
That was a Powell favourite, wasn't it?
That was a Powell favourite when it was quite low.
Yeah, of course. Yeah, when it suited the narrative that they
Yeah.
wanted. Yeah.
Absolutely. So so this super core measure, the Fed believes this is the stuff that monetary policy can influence. Monetary policy can slow the economy, can slow job growth and wage growth. And that is the kind of stuff that will feed through into slower services inflation. So we strip out housing because, to some extent, that's not so directly affected by interest rate policy, although it is. So they came up with this super core measure of inflation, and
Which now's not suiting their narrative.
well, yeah,
again,
we can
yeah,
see
yeah,
it. We can see it on the chart. You know, for Powell was talking about the 6 months annualized rate of super core inflation when it was low.
What, middle of last year?
Yeah, middle of last year, and now,
Surprise.
yeah, and now now the game's changed. So we had two very steep increases in supercore, in the supercore CPI, should we say? So the month-over-month increases in the index for the last 2 months have been much stronger than they had in the previous few months.
Do you think that the slower wage growth is going to feed into these figures maybe into the middle of this year? They will slow up again. What's your thoughts there?
Well, wage growth hasn't slowed that much. It's like I said, you know, it's been stuck at 4.3% year over year for a while. So,
Well, all right, maybe I'm talking about the NFIB survey, and we're
and the
talking
quits
about
rate.
the quits
You're
rate.
talking about forward indicators of wage growth. Well, that's great. Yeah, you can look at forward indicators of wage growth and say, well,
that
I think
translates
that
into
means
X.
wages
Yeah.
growth is going to slow, and if wage growth slows, that should slow down these core measures of inflation. But that hasn't happened yet. And like all these forward-looking indicators, there's no guarantees. What I can guarantee, and you don't need a crystal ball here or some, you know, designer index to tell you this. You've only got to look at this chart. And this, if you sum up all these monthly increases, you get to the year-over-year increase. And in a few months' time, when the May and June increases, which were close to zero, drop out of the one-year window, you're going to see a stronger acceleration in year-over-year supercore inflation.
Because the comparison is just less. That's
This is kind of baked in the cake, and you can't get away from this. So, if I was there sitting at the Fed right now, I'd be rather concerned about pulling the trigger on some rate cuts and stimulating the economy even more.
Or regret that they were looking at the supercore inflation.
Well, yeah, but I think other core measures tell pretty much the same story. You know, it's one where, and sadly I didn't bring other charts with, but whichever way you look at this, and whichever thing you want to exclude from core inflation, whether it's medical care services, energy services, housing, any of these you take out of the picture to try and make it look better, you're left with still an elevated level of services inflation. And when I say elevated, I mean it's coming down slowly, but it's still north of 4% for most of these measures.
I'm just going to make this clear to everybody what we're talking about here. This is just opinions, and all those opinions are in our Supermacro morning note, which is available here. You click on the link, you go straight to the website. You can see, I think there's 3 early issues you can read through. You can subscribe for 1 month, I think for 30 cents. Then after that, it costs you 50 quid a month. Sorry, 30 pence, and then 50 quid a month. Worthwhile at least taking the free trial for a month, and you get a feel of what we're talking about, which is what we're talking about, which is what is in the notes.
Yeah, thanks, Health. I mean, I just want to make it clear, I'm a trader before an economist. This is all these charts that I put together. This is my own opinion of how I see the economic data and what I think. And I do take opinions from other economists, plenty of other economists. And I look at the contrary opinion, but I don't, my own personal view is that the Fed doesn't really need to cut rates at this stage of the game, but they will.
Do you know, it's just as an aside, I read a lot of what economists talk about. The problem I find with a lot of those guys, they're like driving a car permanently looking in the rearview mirror. They don't look ahead to what they think is going to happen. They look at what has happened and what it means for going forward, rather than just looking out the front window and saying, oh, it's happening. Well, we look at the yield curve. This 108th recession we're supposed to have had in the last, 2 years.
Yeah, I've never been a big fan of using the yield curve to predict the recession possibilities. But while we're on that subject, perhaps we should move on to this final chart, and one of the reasons why I am still quite bearish on longer term fixed income.
Okay. What's this? Yeah. Take us through. This is nominal GDP growth and the 10-year Treasury yield on the same chart.
Yes, this is a chart of average nominal GDP growth over 5 years with the 10-year Treasury yield. And for years, the 10-year Treasury yield, it's not just a coincidence. It did kind of track average nominal GDP growth until we had the Great Recession. And then, both, it still tracked it. I mean, both nominal GDP growth collapsed, and so did the 10-year Treasury yield. And
just on one period of that, this is where the big gap is from, looks like the start, just towards the end of the GFC, 2013, 2014, to just before the pandemic. And that was when we had QE.
I think you've got to be a bit careful here, because we had a very, very deep recession in 2008, 2009 that was in the 5-year window for 5 years. You've got this trailing, you've got a couple of quarters of really deeply negative growth until you get to 2014, and then you're looking back 5 years, and those negative growth quarters are out of the picture.
I was more thinking about the 10-year Treasury yield, because there was the natural buyer in the market. A central bank was natural buyer of 10-year Treasuries, so the yield was being held down.
Yes, yeah, to some extent. You should expect that there was more demand than perhaps supply was keeping the yields anchored.
Artificially low. We've
that
seen
was the whole point of QE.
Yes,
really.
yeah.
That was the whole point
the
of QE.
Total unproductive investment that came out of it.
Yes, but and then of course once the pandemic struck, and you can see GDP growth collapsing there and then rebounding, there was a long period where people doubted really that we had broken through from the previous decade of really low growth and low rates. And I think the market is still struggling to accept that. The expectations are anchored by the prior decade.
Yes. And this time around, we've got a central bank that's trying to reduce its balance sheet rather than increase it. So the potential for those yields to go from where they are now, 4.2, to what you're suggesting, they could get as high as maybe 6.5%. It suggests
They could do. I mean, I do think for the 10-year Treasury yield, it's going to make its way back towards 5%. whether the Fed cuts or they don't. I mean, I think they will. And the market, certainly for the longer term Treasury yields, could have an adverse reaction if growth stays strong.
So let me just summarise here. If the Fed goes ahead, and let's put a number on it, cuts 3 times this year, there is a chance that if inflation stays strong in the middle, say Q3, early Q4, we see a sell-off in the Treasuries as the market starts to think the Fed hasn't got the inflation hat on. You're not worried about it.
I think that is the danger, that inflation gets a kind of second wind, if you like. The disinflationary forces in energy, food, and durable goods prices, they're all spent. And so instead of those being, if you like, a kind of headwind to inflation, they become a partial tailwind. And you're left with services inflation, which
doesn't go down.
At the moment, it's not going down.
Yeah,
it's fine if productivity really makes a dramatic step upwards, but it's hard to get productivity growth in services industries. It's fine in manufacturing industries.
The technique for manufacturing can be improved.
You think of the last century,
yes,
from you just introduce a whole load of machines, pour the metal in one end, and out comes a load of cars. That's great. That's a dramatic improvement in productivity. But for services industries, it's hard to improve them.
Okay, so now let's get to the bit where probably most people listening will want to hear. They know what your thoughts are. I think you've said that you feel as though the Fed's putting itself in a corner, which is not going to win either way. Tell us what the trades are. What's on your mind? What have you got in your portfolio? What are you thinking about putting in your portfolio?
Well, for that, you've got to subscribe. But
www.super-macro.com.
I will say this at the start of this year, and I was quite clear. The market was pricing in 6 rate cuts for this year, which I wrote in the note. To me, was just insanity.
I think that's the word you used, actually.
Yeah,
I'm pretty certain. Yeah, it was
yeah. And of course, I had that trade on in short-term interest rates futures,
SOFR futures.
Yeah, for the December SOFR futures and the March futures. I've unwound that trade completely because right now the market price is in
four. Is it now? 4?
Well, yeah, pretty much 4 rate cuts, maybe a bit less now. Between 3 and 4.
So what is your current trade? What's your current position? Are you short treasuries?
And yes, I'm short treasuries.
In a degree of, say, take it from 0 to 10, 10 being the treasuries are going down the bog hole. It's actually certain to
10. I was 10, 5 times leveraged short of treasuries in at the start of 2022 when the yield was 1.2%.
Where are you now?
Right now, on that scale, I'm at a 3.
Okay, fine. So you want a short position, but it's not hugely compelling.
It's compelling enough. Let's put it that way. It's compelling enough. The fact that the Treasury has bounced off 4% now, I do think I'm not a great fan of technical analysis. It's useful. I don't just use technical analysis to the exclusion of everything else. Obviously, I look at the fundamentals primarily, but if the technicals line up as well, then that's great. Then you've got a good trade.
So are treasury options then a place to be then if you're concerned about the volatility of the actual cash market?
What I'm doing is I am slowly scaling up the position, but I'm also leaving a kind of trailing stop by using short-term upside options in treasury futures.
Right, so you're buying calls, being short the future.
Yeah. Or doing a risk reversal, short some out the money puts.
So it pays for the premium but takes you out if it goes low enough.
Yeah.
Okay, fair enough. Okay. Equities, tell us what you're thinking there. US equities, we know what they are. You've been telling us you've been spending 20 basis points a week sort of buying some put spreads, which, depending on how you dynamically hedge them or whether you trade out of them, has probably lost you some money, I guess.
Yeah, I've got a core long position in European banks.
That's been a nice position.
Yeah, that's great. I can go through the, you see it in the morning notes, once a week when I update the details of that trade. But for me, for the S&P, I'm a little bit conflicted. on the basis that financial conditions are so easy and the Fed plans on doing more easing further this year, I think they're going to add fuel to the fire. So the equity market could run a lot further. It could easily run a lot further. I'm just very, very cautious of a pullback, and which we're bound to get at some point. And the implied volatility in the options market, as you know, is incredibly low. It's barely in double digits on the S&P.
So you could spend some of your upside if you were long the S&P or long equities by buying a little bit of protection, and it wouldn't affect the performance that much. Is that what you're telling us?
Absolutely. Right now, the drag on performance is minimal. And in a future episode, I guess I'll bring in, I'll show the chart of that, of how a protected position in the S&P is doing relative to the S&P.
Thank you, Jonny, for the education today. I've enjoyed it. I've got something from it. I hope other people listening will as well. If you want to reach us, it's Elvis at super-macro.com. As you know, the website, www.super-macro.com. If you want to subscribe to the newsletter, as I said, it's to get a free 30-day trial. Thank you all for listening. We should have another one available with these podcasts in a couple of weeks.
Yep. Thank you, Elvis. Please do subscribe. I hope you enjoy the newsletter.